My name is Chris Campbell. I'm a practicing CPA, and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So for you real estate investors out there, I wanted to talk about 1031 exchanges. I got a phone call from a client the other day that was interested in doing some 1031 stuff. They had heard about it. It is a great way to save on taxes, and it is. It's actually a great tool to use to save on taxes. But as with anything else, there are some requirements that you have to go through to make sure that you execute a 1031 exchange properly. So to explain essentially what a 1031 does is a 1031 allows you to exchange one property for another, specifically real estate. So if you have one piece of property, and let's say that you want to upgrade it, you can essentially swap out one property for another. And if there's gain, let's say you held on to a property for a while, you want to upgrade the property to a different property, you can essentially avoid or delay, because you don't necessarily get rid of the taxes, you just delay paying the taxes. That cost goes into the property that you exchange into, and then once you sell that exchange property, you would then pay the taxes that you would have paid on the original property. So one misnomer or myth or one misunderstanding that many people have is that you avoid taxes forever with a 1031, and that is not the case. You're simply delaying the taxes that will be paid. So they will eventually get their money, their bread, but it's delayed. Now, there are a couple of requirements to make sure that you've executed it properly. And one of the big issues that I run into when dealing with clients is they come to me too late and they say, okay, I had this property, I sold it. So the first thing you need to realize is that this only applies to business real estate. So specifically rental properties that this applies to. So it can't be for your personal home. This does not apply to flips. I repeat, this does not apply to flips. So if you are a flipper, you can't do a 1031 exchange. You can't fix it up and send it out right away. So the guideline is you have to rent it out for at least a year. So if you are in the flipping business and you want to try to take advantage of it, rent it out for a year and then execute the 1031 exchange. So that's a big thing. It must be a rental at some point. Rent it out for at least a year. The other issue that I run into where it's not executed properly is not using a third party. So people have come to me and they said, okay, I sold this property, and then I went and I purchased this other property, and I'd like to use the 1031 exchange. The problem with that is they didn't use intermediaries. When you're in the process of doing the exchange, once you touch the money, once the money is sitting in your bank account, it's null and void. The exchange is over. So to properly execute the 1031, you have to use what's called the intermediary to execute it. There's a bunch of them out there. If you go and you Google it, 1031 exchange intermediary, there's a bunch of companies that do this. But the thing is, they actually hold the money. So when you sell property one, the proceeds need to go to them and not to your bank account or your company's bank account, whatever entity you're holding it under. But the money needs to go to the intermediary, and then when you purchase the following property, the funds to do so come from that intermediary, that third party, not you. So that is a big thing. So before you get into a 1031 or decide that you want to do it, contact an intermediary, and if with a reputable company, they've done it plenty of times, so they can walk you through the process. But again, as I said earlier, once you touch the money, the exchange is null and void. So you have to be very careful to do that. The other thing is there are timelines when executing a 1031 as you're using that intermediary. So there's two timelines that you have to take into consideration. First one is 45 days. 45 days from you selling the property, you must identify the next property that you're going to exchange it for. It can be multiple properties, so it doesn't have to be a one-for-one. So let's say that you have a huge gain on one property and you want to break it up into multiple properties, you can do that. So the one to multiple is fine, that's a go, but they must be identified within 45 days of you selling. That
property and it must be in writing. So the whole idea is you can't go sell something and then sit around for a couple years saying, yeah, I'm waiting for my 1031. So that is crucial timing for the 1031 to stand. The next deadline is 180 days. So in 80 days from the sale of the initial property, you got to be in the next property. So 180 days is roughly 6 months. So within 6 months, you got to close on the next property that you're moving into. Again, otherwise it's null and void. You have to identify it and be in it within 180 days. So those are the main things that you have to consider with a 1031 and to kind of do it right. But I just wanted to dispel a couple of misunderstandings that people may have about it. So that's all for now. If you have any more questions about this particular subject or any other tax or accounting questions, feel free to reach out. Happy to help. And I'll see you in the next one. Take care.